Good evening to all of you. Please confirm whether audio, video, everything is clear at your end. Yeah, please confirm. Audio, video, everything is clear at your end. Okay, so two people have commented, yes, clear, sir. Okay, fine. So today we are going to discuss about the Forex part 1 we have already covered, and there we have discussed about Forex transactions and all. And today we are going to discuss the very important topics, export and import. Then we are going to discuss about the LC. Then we are going to discuss about ECB and trade credit. So subject to availability of the time, we'll see if any part remains, then we may continue tomorrow. So generally for clerical to officer, so here very basic questions only will come. So you need not worry if you see new terms or some lengthy processes, you need not worry. And ECB and trade credit and all you can skip. Okay, so once the LC part is over, LC also only that UCPDC full form and all will be applicable to you. So you can skip the last part if you want. If you want to get the knowledge, you can continue, or else you can skip the part. So it's your wish. But 1 to 2 and above, you have to appear for that. So before starting with the session, just 1 minute. Please wait 1 minute. So yesterday I have said, in the group, some of the focused topics for scale 3 to 4 and 4 to 5. So generally, if you see last 2-3 years exam trend, for 3 to 4 and above, the questions are very lengthy. And if you see in the year 2020, no one was able to recollect the questions. So all the questions were from the policy and very lengthy questions were asked, right? So whatever we have seen, we have observed that many questions are coming from the different policies, because 3 to 4 and 4 to 5, when you go the higher scales, so policies are very relevant. So that's why many questions are framed from there. So all this whatever I have given, these all are recent circulars. Okay, these all are recent circulars. Within last 1 year it has come. So from this last part you can get it from my RBI, that capsule. So it is mentioned there, you can go through it. And schemes already it is there in the booklets are there, so there you can you can get the schemes. But for corporate lending there were schemes like ethanol project financing, corporate long-term loan, repo linked short-term loan. So these were issued. So that's why you have to focus, you have to see these schemes. Then microfinance institution TLMFI scheme also has been launched. So we may expect some questions from these areas besides retail agri and MSME schemes. Okay, baki all are I have given to you. If you are not getting any of the topics, then you can, these all are recent circulars, as I say, maximum are recent circulars only. Okay, so or else I will do one thing, I will do one video and will post tomorrow evening, so that you will be able to get the circulars or the policies numbers. At least I can show you here so that you can download. So that is about for 3 to 4 and 4 to 5. Now we'll go straight away to the session. So the session is on Forex part 2. As I told you, first we'll start with the export. Okay, we'll start with the export. Someone has asked focused topics for 0 to 1. 0 to 1, all topics are important because questions will be very basic in nature, and it will the generally the examiner put from every areas, all areas they give the focus. Many, maximum focus is given for 0 to 1 is the general banking. For 1 to 2 also all areas. Don't ask me focused topics. Now we'll start with the export. No voice. Can anyone confirm? Some Vivek Razak sir says it is there is no voice. Please confirm. Please confirm someone so that we'll go ahead with the session. Whether I am audible to all of you. No sound. 1 minute. Just 1 minute. Time is being wasted. Yeah, please, someone, please, someone confirm whether now I am audible to all of you. Please, someone confirm whether I am audible. So if I am audible, then I will go ahead. Okay. Okay, now I got some reply because there is some delay in the live stream and the video, so that's why I'm getting little delay. Okay, now we'll start with the export. Okay, will not waste time. Now, for 0 to 1 and 1 to 2, export, okay, and import, both are regulated by DGFT. Okay, both are regulated by DGFT, that is Director General of Foreign Trade. So DGFT full form also you have to remember, and export and import is regulated by DGFT, Director General of Foreign Trade. Then next variable, next very important is the realizable time frame. Okay, the realizable time frame for export proceeds. Okay, now when you are doing something export, okay, when you are doing something export, so goods is going out of the country, isn't it? Goods is going out of the country. So government of India says when you are sending something out of country, so you should realize, okay, you have to get it back, so you have to get the money back. So within what time frame is given? So for export credit, the realization or the repatriation of the export proceeds should be within 9 months from the date of export. Very important. Okay, it should be within 9 months from the date of export. So this is for export credit. So when you are exporting something, okay, when you are exporting something, so you should get it back. Okay, you should get it back, the money or the, whether the realization or the repatriation within 9 months. But when you are exporting to the warehouse which is established outside India, suppose you are having a warehouse outside the country and you are sending there for selling. So when you are having the warehouse there, so then the realizable time frame is 15 months. Okay, then the realizable time frame is 15 months from the date of shipment. So when you are doing shipment, so from that date 15 months is the time frame within which you should get the realization. Okay, you should get the money back. However, because of the COVID-19 pandemic in the year 2020, okay, so those exports made up to July 31st, okay, those exports made up to or on July 31st, so for them, instead of 9 months, okay, instead of 9 months, the time period is 15 months. Okay, instead of 9 months, the time period is 15 months. But by now I think this may not be relevant, but if it is asked at all, okay, so then you should know it. So July 31st 2020, so the exports up to July 31st 2020, okay, can be realized within 15 months. Next is processing of export related receipts through OPGSPs. OPGSPs means, okay, OPGSPs means online payment gateway service provider. Okay, online payment gateway service providers. So suppose by you are making something export, okay, and you are getting the payment receipt through this online payment gateway. So the value should not exceed up to 10,000 US dollar. Okay, so this also value you should know. So when any export proceeds is done through online payment gateway service provider, that is OPGSPs, the value should not exceed US dollar 10,000. Okay, US dollar 10,000. Next, extension of time. Okay, extension of time. Suppose one exporter, okay, one exporter is not able to realize the export proceeds, okay, is not able to realize the export proceeds beyond the stipulated time of 9 months, okay, beyond the stipulated time of 9 months, then extension of time period can be given up to a period of 6 months at a time. Okay, up to a period of 6 months at a time, irrespective of the invoice value of the export, subject to the following conditions. Subject to the following conditions. What are the conditions? First condition is the export transaction covered by the invoice are not under investigation by the Directorate of Enforcement, CBI, or any other investigating agencies. Second condition is AD1 branch is satisfied by the reason provided by the exporter. So AD1 branch should get satisfied the reason quoted by the exporter for the delay. Then the third one, the exporter should submit a declaration that the export proceeds will be realized within the time frame. Whatever we are extending within the time frame, okay, it will be realized. The last most important thing is, if you are extending beyond 1 year from the date of export of the goods or services, then the total outstanding of the exporter should not exceed 1 million US dollar or 10% of the average export realization the exporter has done during its 3 preceding financial years. That means beyond 9 months also the realization period can be extended. So when I come to bank for extension, at a time 6 month only extension will be given by the bank. Okay, then this extension bank will give subject to condition that whatever the transactions are done during in the export, that is not under investigation by the Directorate of Enforcement, CBI, or any other investigating agencies, and whatever the reason provided by the exporter is satisfied by the AD category 1 branch, and he has submitted a declaration that he is going to realize the export proceeds within the time frame extended. And the last one is, again the last one is while considering extension beyond 1 year. So if you are considering the extension of the realization period beyond 1 year, then you should ensure that the total outstanding of the exporter does not exceed 1 million US dollar or 10% of the average export realized during the preceding 3 financial years. So whatever last 3 preceding financial year, whatever the export proceeds he realized, average of that 10% of that, okay, should not exceed. So that is only you have to see here exam point of view. So specifically for higher scales conceptual question may come, so that's why it has been framed. Then settlement system for the export. Okay, so there is an update on this topic, so that's why I have added here recently. So Asian Clearing Union is there. So the member countries of this Asian Clearing Union, so for them the export realization is happen in the ACU dollar, ACU euro, and ACU Japanese yen. So among the Asian Clearing Union members, the realization of export happens in this ACU dollar, Okay, SU Euro, SU Japanese, and SU Japanese Yen. Then trade transactions with Myanmar. So now there is a update on this. So earlier only SU mechanism, means SU dollar and euro and Japanese was there. So now it can be done through SU mechanism as well as any free convertible currency. Okay, as well as any free convertible currency. Next is Iran. Okay, so for Iran, any permitted, so from 2010 it has been allowed, that is all the export relation, okay, all the settlement will be done with the Iran, any permitted currency outside the purview of the SU mechanism. So for Iran, the settlement will be done outside the purview of SU mechanism, any permitted currency, okay, on any permitted currency. Next is export of goods through custom port. Okay, so this slide is just for to get an idea. I put it. So here only important is this 21 days. Okay, this only important is here 21 days. So if any conceptual questions are framed for higher scales, so you can get some idea. So that's why this slide I have put. So when any goods, okay, are exported through the custom ports, it is a non-EDI port, means non-electronic data interchange port. So customs shall certify the value declared and give running serial number on the 2 copies. So here you have to understand the 2 copies will be given by the custom, and then original copy the custom department will customs will be retaining to send it to the Reserve Bank of India, and it will return the duplicate copy to the exporter. Okay, it will return duplicate copy to the exporter. Now after the shipment of goods, okay, after the means at the time of shipment of goods, the exporter will submit the duplicate copy of the export declaration form to the custom department, and the custom department will verify all the goods and everything. Then they will return it to the exporter. They will return it to the exporter. Now exporter will come with that bill along with the invoice and other things, okay, to the AD branch, okay, because that bill negotiation and all will happen, no? So that's why it will come to AD branch for submission. What is the time frame? So within 21 days from the date of export, okay, within 21 days from the date of export, it should come and it should submit to the AD branch. Then once the documents are received at the AD branch, so they make entry in the EDPMS. Okay, they make entry in the EDPMS. So it is applicable only for higher scales. It may conceptual question may frame how many copies will be there, then where submit and all will happen. So for that only I have put this slide. Okay, or else it's not that much relevant. So 0 to 1 and 1 to 2. EDPMS. EDPMS full form is Export Data Processing and Monitoring System. EDPMS is Export Data Processing and Monitoring System. Next is grant of EDF waiver. Okay, grant of EDF waiver. AD category 1 banks may consider request for grant of EDF waiver from exporters, that is who are status holders. Status holders are those exporters having a good track record of the last 3 years. Okay, of the last 3 preceding year, they are having a good track record, so they are called as a status holders. So this has been newly added in the export master circular of RBI. So that's why you should know it. Okay, you should know it exam point of view. So maybe question may be framed from this area. So AD category 1 banks may consider request for grant of EDF waiver for the status holders, provided up to what limit they can do it. Okay, EDF waiver is permitted up to what limit for the status holder? Annual limit of 2% of average annual export realization during the 3 licensing years for all the exporters. Okay, for all the exporters, that is 2% of average annual, okay, 2% of average annual export realization during the last 3 licensing years, or annual limit of rupees 1 crore, or 2% of average annual export realization during the preceding 3 years, whichever is lower. Okay, whichever is lower. But if it is, means in case of supply of pharmaceutical products, vaccines or life saving drugs, okay, then 8% of the average annual export realization during the preceding 3 licensing year is permitted. So what you need to know is, grant of EDF waiver to the status holders is permitted up to 2% of average annual export realization during the preceding 3 licensing year, subject to maximum annual limit of 1 crore. Or if the status holders are doing export of pharmaceutical products, vaccines or life-saving drugs, then they can go up to 8% of the average annual export realization during 3 licensing years. So this has been added, okay, this has been added newly in the circular, so question may be expected. Then EDF approval for trade fair or exhibition. Okay, EDF approval for trade fair exhibition. Now any company wants to export their goods for a trade fair, means he wants to participate in a trade fair. Suppose you want to, okay, show your product, okay, you want to show your product in Australia or any other country, okay, so you want, there is some exhibition going on and you want to participate and you want to market your product in the exhibition. So you are not required to take RBI approval, so you can export the goods without prior approval of Reserve Bank of India. But here the condition is, whatever unsold, okay, whatever unsold items are there, so you can sell it there, okay, you can sell it there. But if you are giving as a gift, if the unsold goods you are giving as a gift, you are permitted up to $5,000 per exporter per exhibition of trade fair. Okay, so per exporter per exhibition trade fair is $5,000. So this is for that, if anyone is participating, okay, if anyone is participating in the trade fair. Next is advance payment in case of export credit. Next is advance payment in the export credit. Now suppose I want to send something as an export. Now I may demand, suppose my client is there in USA, I will say you make me advance payment. Okay, you make me advance payment. So I can take advance payment from the overseas buyer. My overseas buyer will make me payment. But if I don't send him the goods, okay, if I don't send him the goods, then it's a image of country also, if you are getting defaulted, if you are not sending it back. So that's why there is a rule, whenever you are receiving any advance amount from the overseas buyer, you have to ship the goods within 1 year from the date of receipt of advance payment. Okay, within 1 year from the date of receipt of advance payment. And whatever the advance payment, generally if someone is paying advance, so definitely he will charge interest. Okay, he will charge interest. So whatever the interest is there, that interest should not exceed LIBOR plus 100 points. Now you may ask, sir, LIBOR is not there, you said in the last class. So there is no update on that. So you will see if there is ARR, okay, alternative risk rate, okay, alternative reference rate plus 100 points is mentioned in the option, you can mention there, or LIBOR plus 100 is there, you can click on that. So the maximum ceiling, okay, maximum ceiling on the interest rate for the advance payment which you are receiving from your overseas buyer is LIBOR plus 100 basis point. Now if the exporter is not able to ship the goods within the 1 year, okay, not able to ship the goods within 1 year, then refund can be done, okay, refund can be done only with the consent of the RBI, only with the consent of the RBI. 1 minute. Okay, only with the consent of the RBI. But if the exporters are having good track record, okay, if the exporters are having good track record of 3 years, they are allowed up to 10 years, okay, they are allowed up to 10 years. But receipt of such advances should be below 100 million. So up to below 100 million only are allowed, okay, those who are having good track record of 3 years, they can, you know, they can ship the goods even after 1 year. They are allowed up to 10 years time to ship the goods, but provided the value should be below 100 million, below 100 million US dollar. If it is 100 million or more, okay, if it is 100 million US dollar or more, it has to be reported to Trade Division Foreign Exchange Department of RBI, okay, then it has to be reported Trade Division Foreign Exchange Department of RBI. Next important thing, setting up of offices abroad and acquisition of immovable property for overseas offices. Okay, setting up of offices abroad and acquisition of immovable property for overseas offices. Now at the time of setting up of offices, so any, okay, Indian firm or company wants to set up a office abroad, so suppose in USA or any other country, okay, suppose in USA or in any other country. So if the company if the company wants to set up a branch office, then AD category 1 branches may allow remittance towards the initial expenses up to, okay, initial expenses up to 15% of the average annual sales or the turnover or the income during the last 2 financial years. Okay, 15% of the average annual 15% of the average annual sales or income or the turnover during the last 2 financial years, or up to 25% of the net worth. So two things here, whatever net worth of the company up to 25% of the net worth, or 15% of whatever the sales or the turnover or the income was there, okay, in the company, average of that, okay, last 2 years will be, whichever is higher, up to that amount only the company or the firm can spend for setting up a office in the overseas offices, okay, in the overseas offices. Next is for the recurring expenses. This is for setting up of the office. Next, for the recurring expenses, up to 10% of the average annual sales or income or the turnover during last 2 financial year can be sent for the purpose of normal business operation of the office. Okay, so 15% and 10%, and there in 15% you have to understand that 25% of the net worth also is there. Okay, so this is for the setting up of the office abroad. Next is very important. Okay, next is very important, and These all are recently added, in the export. Last 2-3 years only it has been added. So examiner focus will be in these areas. Write off, okay, write up of unrealized export bill. So if any export bill is there which is unrealized, okay, which is unrealized, then how write off can be done? So the write off, self write off by an exporter. So the exporter himself, okay, can do the self write off other than status holder, okay, other than status holder. 5% of total export proceeds realized during the calendar year preceding the year in which the write off is being done. So this year if the write off is being done, 5% of the 5% of the total export proceeds realized, okay, total export proceeds realized during the calendar year preceding to the write off year. So suppose this year we are planning to write off, so previous year whatever the total export realization means whatever export he has done, how much he has got it back, okay. So whatever the total export realization is there, 5% of that other than status holder. Status holder, they can write off up to 10%, and AD category 1 branch also can do write off up to 10%, okay, up to 10%. And this write off, okay, write off also one report is there, so that I will update here and send you, okay, that I forgot to update here. Half yearly report is there, write off bill something it says. I'll update here and send the document when it, okay. So write off reporting also has to be done to RBI half yearly, okay. So that form name I forgot, so I will update here once I share the document, so you can find it here, okay. Now exporters caution list. So why all these things I am telling, because in the overseas exam also few questions were asked from these areas, so particularly I have picked up the areas, okay. So IBPS only conducted, so here these areas only he took for framing the question in the overseas posting exam recently held. Then exporters caution list. So there was a question, who will recommend, okay, okay, to put in to put the exporter in the caution list, okay, to put the caution list. What will be the, it was a question like that, what is the order, what is the proper order for putting the exporter under the caution list? So it is the AD bank, okay, it is the AD bank concern. So AD bank will be recommending to Reserve Bank, okay, AD bank will be recommending to Reserve Bank for adding a exporter under caution list, and also for decaution listing also AD bank will recommend to the regional office of RBI. So this one you should know, it was asked, okay, it was asked in the exam. Next is the import, okay, next we will go to the import. Now what is the time limit for the import? So in case of export we have seen, that is three things I told you. In case of export, that is 9 months, okay, then 15 months. So here it is 6 months, okay, here it is 6 months. Anything, okay, anything if you are importing, okay, anything if you are importing from other countries, okay, you should make the remittance against the import, okay, you should make the remittance against the import not later than 6 months from the date of shipment. So the time frame is on which date the shipment was done, okay, on which date the shipment was done. Within 6 months you have to make the remittance, whatever import you have done, within 6 months you have to make the payment. And as we have seen in case of export, whatever export happened up to July 31st 2020, 15 months time was given. Similarly in case of imports which was done up to including July 31st 2020, So the time frame is 12 months. Okay, so it is enhanced from 6 months to 12 months. Now, AD category 1 banks may permit settlement of import delayed beyond 6 months. Okay, so beyond these 6 months, if any party is coming for the settlement against the import, AD category, AD branches will permit, provided the interest, if any, is charged by the overseas supplier. Okay, the interest charged by the overseas supplier up to 3 years is permitted. Okay, the interest payable is up to 3 years only permitted. More than 3 years from the date of shipment will not be considered. And the time limit for the deferred payment arrangement. So anywhere if the deferred payment arrangement is proposed, deferred payment arrangement means, okay, in installment way, if anyone wants to pay, so the maximum time frame is 5 years. Okay, the maximum timeline is 5 years. And for import of books, okay, for import of books, the remittance time period is not there. So there is no such timeline if you are importing the books. Okay, there is no such timeline if you are importing the books. Then when any importer is coming that he is not able to remit the money and it is beyond 6 months, again the same concept will come here, like in case of exporter also, 6 months at a time, it was, time is given at a time, 6 months, 6 months, like that extension was given. Similarly for the importer also, at a time 6 months, 6 months will be given, but maximum period is 3 years only. Okay, maximum period is 3 years only, irrespective of the invoice value for the delay. And when the extension goes beyond 1 year, there also the condition was there that it should not exceed 1 million or 10% of the average import remittance during the preceding 2 financial year. There it was average export remittance during 2 preceding financial year. There it was higher, but here it is lower. So this one you have to remember. Okay, there it was higher, but here it is lower. Then issue of guarantee by AD branches for the import. Okay, so one question expected from this, because obviously all scales it is one question is asked either for the goods or for the services. In case of imports without banking bank guarantee or standby LC, advance remittance up to $5 lakh for the services and $2 lakh for goods can be done. So if you want to, okay, if you want to purchase some services, or if you want to purchase something, or if you want to import some services, or if you want to import some goods, so without any bank guarantee or LC, up to $5 lakh for services and up to 2 lakh for the goods can be imported. Okay, can be imported. More than 5 lakh and more than 2 lakh for services and goods respectively, you require a standby LC or the bank guarantee. That's what the meaning of that. So either way the question comes in the exam, you have to reply. And advance remittance is not permitted for import of the conflict diamond, and there is a Kimberley certificate which is related to import of the rough diamonds 0 to 1 and 1 to 2. So many times it is asked, examiners, maybe it is a favorite question, many times it has come. Kimberley certificate is related to what? Okay, so it is a import of the rough diamonds. Okay, so this Kimberley certification is required if you are importing any rough diamonds. Okay, then receipt of import documents by the importer directly from the overseas supplier where the value does not exceed $3 lakh. So if the value of the bill, import bill does not exceed 3 lakh US dollar, then the importer can receive the import documents directly from the overseas supplier instead of routing to the AD branches. Okay, so that is up to 3 lakh dollar it is permitted. Similarly, processing of import related payments through OPGSP's online payment gateway. So in case of export it was 10,000 US dollar, but in case of import it is $2,000 only. Okay, in case of export it is $10,000 and in case of import it is $2,000 only. So you may feel that, sir, where you are, you are putting all these things. It's all I am putting because IBPS has recently conducted the overseas exam. So in that exam, many questions were framed from this area only, from the import circular and the export circular. So I am picking up the questions, or picking up the points from there only, because that gives us the idea that when a question maker sees the circular, which area is the focus of the question maker. Okay, then in case of export and import, so what is the documentary evidence? So documentary evidence for the export is the EDF, export declaration form for the non-EDI port, and if it is a EDI port, then it is the shipping form bill. And many times this question has come for the software. Okay, so what is the documentary evidence for the software export? So it is the SOFTEX, SOFTEX. Okay, SOFTEX. So that you should know the full form, means the proof of export of the software is the SOFTEX. Then for import it is bill of entry or custom assessment certificate, or if it is done through the postal, then it is a postal appraisal form. Then this 0 to 1, 1 to 2 and 2 to 3, EDPMS and IDPMS full form you should know. Export data processing and monitoring system, import data processing and monitoring system. Okay, EDPMS and IDPMS, these are the portal, online portal. Earlier used to send manually so many returns, but now after the introduction of this EDPMS and IDPMS, everything is online now. Next is very very important. So irrespective of the scale, crystallization of export bill and crystallization of import bill. So generally export bill is asked several times. Okay, export bill is asked several times because it has been changed now. Okay, it has been changed now. That is maybe 3-4 years back it has been changed, but it has been made now that banks are free to fix the period. Okay, individual banks are free to fix the period when they are going to crystallize the export bill. Crystallization means, okay, converting the forex, okay, exposure into Indian rupee. Okay, whatever the exposure is there in the foreign, okay, currency, so converting that to Indian currency is called your crystallization. So export bill outstanding is there means, okay, bank is going to crystallize it because risk will be there, market risk due to fluctuation of the currency. Okay, so if the currency rate is 70, now if it is going to become 80 rupees, okay, so that means 10 rupees will be the loss. So that's why what will do, bank will crystallize. So crystallization period is fixed by the individual banks. Okay, individual banks. Then for import bill, okay, for the import bill, so generally two types of bills are there, maybe a site bill or the demand bill or the usance bill. So in usance bill, the due date will be mentioned there. So on the due date crystallization happens, but question comes for the demand bill or the site bill. Okay, the question comes for the demand bill or the site bill. Okay, so for the demand bill or the site bill, the 10th day, okay, the 10th day will be the crystallization. Okay, the 10th day will be the crystallization. Now next is your another question comes very often from this forex part. Normal transit period prescribed by FEDI is 25 days. Okay, normal transit period prescribed by the FEDI is 25 days. So this you have to remember, exam point of view. Then the very important thing is, what is this normal transit period? The option will be there. Many people do the mistake. Okay, many people do the mistake. So here please remember, the normal transit period means the average period involved from the date of negotiation or purchase or the discount of the bill. Okay, date of negotiation or purchase or the discount till the receipt of the bill proceeds to the nostro account of the bank. So very important exam point of view, several times the question has come. Okay, so what is the normal transit period means? Normal transit period means is the average time period, okay, involved from the date of negotiation or purchase or the discount till the receipt of the bill proceeds to the nostro account. So this is important, you have to remember exam point of view. Then export packing credit, okay, pre-shipment credit and post-shipment credit. So generally from pre-shipment credit and post-shipment credit, only 1 or 2 points are there to remember exam point of view. So what is pre-shipment credit? So always a conceptual question is asked by giving, okay, giving the examples, which one of these type of a pre-shipment credit. So please remember, pre-shipment credit means any loan or advances, okay, or any credit is granted to an exporter for purchase, processing and manufacturing or packing of the goods prior to the shipment. Okay, any processing, I am now any exporter receiving any loan or advances or credit for purchase, processing, manufacturing or packing of goods prior to the shipment, then it is called as a pre-shipment credit. Generally, the maximum period for which the packing credit can be granted at concessional interest rate is 180 days. So up to 180 days the contrast, in concession rate is applicable, and it can be extended up to additional 90 days, and maximum days will be 270 days. So the aggregate period of 270 days the interest concession will be available, not more than that. Then liquidation of pre-shipment credit. So here you have to see, here first pre-shipment credit, the for purchasing of the raw material, packing, manufacturing, everything he is availing pre-shipment credit. Now once it is ready for the shipment, bank will finance post shipment credit. Okay, bank will finance post shipment credit. Now once this post shipment credit will be financed, this out of this post shipment credit, the pre shipment credit loan will get closed. So many a time question is asked, that is pre shipment credit, okay, is liquidated which of the following, from which of the following? First one will be from out of the proceeds from the post shipment credit, next will be your EFC account, okay, then some other options will be there. Now this pre shipment credit can be closed, okay, from the post shipment credit. So it has to be liquidated from the post shipment credit, or if the borrower wishes that he wants to, okay, close the account from the EFC account balance, so then from the EFC account balance also it can be closed. So two options are there for the pre-shipment credit, that is from out of the proceeds of a post-shipment credit or from the EFC account. Second one is post-shipment credit. Okay, second one is post-shipment credit. So generally the loans and advances provided after shipment of the goods. So once you make the shipment of goods against the bill, whatever we are financing, that is called your post-shipment credit. And this post-shipment credit maximum period allowed is 365 days. Okay, maximum period allowed for this post-shipment credit is 365. There it was 180 plus 90, 270. Okay, then this liquidation of post-shipment credit. So pre-shipment credit was liquidated out of post-shipment credit or the EFC account balance. Now this post-shipment credit is liquidated out of two things. One is whatever export bill, okay, you have claimed. So if the realization, okay, if the realization comes from the export bill, so then it will get liquidated, or if the borrower wants, he can liquidate from the EFC balance. So EFC account balance can be utilized for closure of both pre-shipment credit as well as the post-shipment credit. So that's what the question comes from this pre-shipment and post-shipment area. Okay, other than that, not that much important exam point of view. Next is the diamond dollar account. Okay, next is the diamond dollar account. So when we talk about the diamond dollar account, you have to remember this 2335. If you remember this 2335, then it is done. Now what is this 2335? So anyone, see the diamond dollar account. So as the name suggests, it is maintained in the dollar. So the denomination is dollar, right? It is for the exporters who are exporting the rough diamonds. Okay, these are the exporters of these diamonds. They are the eligible for this diamond dollar account. So what is, the criteria of this 2335? So those exporters who have 2 years track record in the export. First two is for the track record. Second one is the 3 crore annual turnover. Okay, 3 crore average annual turnover for the preceding 3 licensing years, and one can open 5 diamond dollar account. One exporter can open 5 diamond dollar account. So 2335, that is 2 years track record, 3 crore annual average turnover for the 3 licensing years, preceding licensing years, and 5 maximum accounts can be opened by that. Okay, so you can remember 2335. Okay, 2335, 2 years track record, then 3 crore last 3 years. Okay, average turnover, 3 years means last 3 licensing years. 5 is the 5 accounts that can be. It is a denominated in the dollar. Okay, it is denominated in the dollar. Okay, next is the gold card for exporters. Okay, next is the gold card for the exporters. Now those who are having good track record of export and their accounts are standard for continuously 3 years, okay, and their account are standard for the continuously 3 years without any irregularities, they are eligible for the gold card. Okay, they are eligible for the gold card. So in gold card, two things you have to remember. Okay, two things you have to remember. One thing is they get need based finance on turnover basis. Okay, they get need based finance on the turnover basis. Second one, this question has come, that is standby limit not less than 20% of the assessed limit may be available for urgent credit need. Suppose 20 lakh you have given, okay, as a need based finance, then 20% of the assessed limit will be always given as a standby limit for these gold card exporters. So two things you have to remember, the benefits for the gold card exporters. One is need based finance based on the turnover. Second thing is 20% additional standby limit is given, okay, on the assessed limit. So whatever assessed limit is there, 20% additional standby limit is given. 20% additional standby limit is given. Then next point is deemed export. Okay, deemed export. So question always comes, and this year also it will definitely come, maybe any scale, okay, but this question will definitely come. So what is called deemed export? Deemed export transactions are those transactions where the goods does not leave the country. Okay, where the goods does not leave the country. Suppose one American company is here. Okay, one American company is here. Okay, he is functioning here in India, and you have provided some material to them. You have sold some material to them, and they made you the payment in the dollar. So country, the goods did not go out of the country. Here only within the country you have to, you have given, and money you have got in the dollars. So these are called deemed export. So there the goods does not leave the country, but export transaction happens. Okay, that transaction happens, you are realizing the money in foreign currency. So that is called your deemed export. Next we will discuss is SNNR account. Okay, SNNR account. Just 1 minute. Just 1 minute. Okay. So this SNNR account is the special non-resident rupee account. Okay, so it is a special non-resident rupee account. It is any person residing outside India. Okay, and any person residing outside India having a business interest in India may open. So any person resident outside India and having a business interest in India may open this SNNR account, special non-resident rupee account. Okay, special non-resident rupee account. Yes, Indian companies in SEZ also will be coming as a deemed export. Yeah. So any person resident outside India having business interest in India may open special non-resident rupee account with an AD branch for the permitted transactions as per the FEMA. And what is important in case of SNNR account is first full form, special non-resident rupee account. Who is eligible? Any person resident outside India. Currency of the account is rupee account. Okay, because non-resident rupee account, so the currency of the account is a rupee account, even though the non-resident is opening, so it is a rupee account. And second one is it is not bearing any interest, so the balance which will be maintained in the SNNR account will not bear any interest. Third one is the validity tenure of the SNNR account. So generally the maximum tenure for the SNNR account should not exceed 7 years. Okay, and beyond 7 years it is not at all permitted. So beyond 7 years SNNR accounts are not permitted. And balance in the SNNR account is eligible for the repatriation subject to payment of the taxes. Transfer from any NRO account to the SNNR account is prohibited. Transfer from the NRO account to the SNNR account is prohibited. Baki all are not that much important, but I will share this PDF with you so you can go through it. Specifically higher skills, if any conceptual questions are framed, then you can go through it. So that is about SNNR account. Okay. Now we will go to the INCO terms. Okay, now we will go to the INCO terms. Then we will discuss about the LC. Okay, then we will discuss about the LC. So first, let me check how many of you are actively listening. So how many INCO terms are there? How many INCO terms are there? Please type in the chat box. Let me see. Yes, how many INCO terms are there? Yes, I'm yet to see from you. Nothing is coming. Just 1 minute. I'll take some water. By the time you can put your messages there in the chat box. 4 plus 5, 6, 10. From where you are getting all this? Till now, 2 answers only have come correctly. Yes. How many incoterms are there? As per the latest. So 3 answers have come. Mukesh, Kumar, Ranjan, Navghan Sahu, Richa Sharma. 11. Okay, so there are 11 incoterms are there. Okay, there are 11 incoterms are there. Now we have to remember the incoterms because 2020 only, few incoterms has been introduced. Now, how to remember? So there are 4 letters. Okay, there are 4 letters in the incoterm. That is our alphabetic C, D, we are putting them in the right side, and E, F, we are putting them in the left side. Okay, C, D, we are putting them in the right side. E, F, we are putting them in the right side. What are these incoterms? First, we'll understand. What are these incoterms? So these incoterms is the terms. That means when a buyer is, 1 minute, just 1 minute. Okay, so we have put C and D here. Okay, then E and F in the left side. Okay, E and F in the left side. Now what is this incoterms? So these incoterms are the terms. Now when a transaction is happening, the seller is selling the goods and the buyer is buying the goods. Right, now the seller is selling the goods and now the buyer is buying the goods. Now till which place the seller has to send the goods and also takes the risk. Okay, till which place the seller will be taking the risk as well as pay all the cost, that will be mentioned in the incoterms. So up to which place the delivery of goods will happen and up to which place the risk will be borne by the seller. So these incoterms expresses. Okay, these incoterms expresses that. Now this C, D, E, F, what are these? What are these? These are the incoterms. Okay, these are the incoterms. So starting with C, there are 4 incoterms. Starting with D, there are 3 incoterms. Starting with F, there are 3 incoterms, and starting with E, there is 1 incoterm. So total, if you see 4 plus 3 plus 3 plus 1, that is, it is 11 incoterms are there. Okay, as per the 2020 incoterms, so there are 11 incoterms. So I put here the seller and I have put here the buyer. Okay, I have put the seller there and I have put the buyer here. Now when the seller is selling the goods, okay, when the seller is selling the goods, so as I have mentioned here, C and D I have put in the right side and E and F I have put in the left side. E incoterm is the less risky for the seller because E stands for EXW, that is X work. Okay, so E stands for X work. So once you do the manufacturing, once your goods are ready, okay, so you just put that on your godown, then buyer will be coming and taking all the things, so all the risk and delivery from my own place, X work. So after finishing work is over, my thing is done. Okay, similarly D is the highest risk. Okay, D is the highest risk, means D stands for these 3. 1 minute. Just 1 minute. Okay, so here is the seller. So where is the, here is the buyer. Okay, so E is the X work, so less risky because everything is, seller will be X work. So at the workplace itself, seller will be leaving and buyer will be coming and collecting. Everything will be borne by the buyer. Now in case of D, it is DAP, DPU and DDP. Okay, DAP, DPP, DPU and DDP. Okay, then here I have made it mistake. It is DDP. Okay, it is DAP has repeated, delivered and duty paid. Okay, delivered and duty paid. I will rectify it. Okay, I'll rectify it when I give it. So DAP, DPU, DDP. So you can see P like this. You can remember this way. Okay, DAP, DPU and DDP. So what do you mean by DAP? Delivery at place. Okay, delivery at place. So here in case of delivery at place, okay, delivery at place, 1 minute. So whatever place buyer will fix, okay, whatever place buyer will fix, so that place delivery will be happening at the destination. Okay, at the destination. Okay, because as we are seeing, D stands for the destination of the buyer. Okay, D stands for the destination of the buyer. It is a all the cost the seller has to bear and he has to deliver at the destination place. Okay, so DAP stands for delivery at place. DPU stands for delivered at place and unloaded. Means it is not only delivered at the destination, it is also unloaded. Okay, it is also unloaded. The third one is delivered and duty paid. So delivered the good at the destination of B and also paid by the seller. So DDP. So DDP is the highest risk. Okay, DDP is the highest risk because here delivered also duty paid by the seller. Okay, delivered also duty paid by the seller. So here it is very easy to remember, as I told you. Again I will repeat. So alphabetical C, D, E, F is the Incoterms. So C and D I will keep in the right side and E and F I will keep in the left side. Okay, so left side will be my seller and right side will be my buyer. So seller, E means X work. It is very less risky. Okay, because the seller has to only create the once the work is over, everything buyer will come and collect and everything will be won by the buyer. And D means DAP, DPU, DDP. So if you get confused with the options in the exam, you can see P is like this. Okay, P is like this, so you can remember that way. So DAP, DPU and DDP. Okay, so DAP stands for delivery at a place. DPU stands for delivered at place unloaded. Okay, delivered at place unloaded. And DDP, okay, DDP stands for delivered and duty paid. Okay, delivered and duty paid. So this is about the Incoterms between E and D we have discussed. Now next, whatever in between F and C, that is if the buyer says, okay, you bring the goods till the ship. Okay, till the ship. So there may be multi-mode of transport or there may be only one mode of transport. Okay, so in case of multi-mode transport, there are, okay, Incoterms, and in case of only the, what you can say, marine, okay, only through the ship, so there are also the Incoterms. Now we will be discussing next. So next is for F and C. So E and D we have discussed already, right? E and D we have already discussed. Next is our the Incoterms with F and C. So in F there are three: FCA, FAS and FOB. In case of C, it is CPT, CIP, CFR and CIF. So you can easily remember, you have to remember PIFI. Okay, PIFI you can remember, so that you can easily remember. PIFI means you just add every a top in SE. Okay, add, because in the first is C, second one is PIFI. So if you put PIFI, then you can add the last one. You can see the options and all, you will get that CPT, CIP, CFR at the CIP. So here it is cow, CAO. So there it is PP, here it is cow. Okay, two things you have to remember. Then by seeing that, okay, then by seeing the options, you will get the third letter. Third letter you can easily get it. Now what are those Incoterms with the F? FCA, FAS, FOB. FCA stands for free carrier. Okay, FCA stands for free carrier, and it will be at the place of departure. So wherever the buyer says, up to that place, from the departure place, free carrier. Okay, seller has to provide the goods. Seller has to provide the goods. Then FAS. Okay, then FAS, free alongside ship. Okay, free alongside ship. Buyer says you bring the goods near to that port, so alongside the ship the seller makes the delivery. So that is FAS, that is free alongside ship. Then FOB. Okay, then FOB, that is free on board. Free on board, it is at the at the named port of shipment. So wherever the port is there, so on the port shipment will be there, so it is free on board. Then CPT, carriage paid to. Okay, carriage paid to. Then your 1 minute. Next is CIP. Here it is cost. Now carriage insurance paid to. Carriage and insurance paid to. CFR, cost and freight. CIF, cost, insurance and freight. Okay, cost, insurance and the freight. So how to remember these all? These two and these two, okay, these two and these two are for the shipment, okay, for the marine route, okay, for the marine route. Baki all, if you accept FAS, FOB, CFR and CIF, if you leave these four, baki whatever Incoterms are there, that are multi-mode transportation. Okay, for that is for the multi-mode transportation. But FAS, FOB, CFR and CIF is for the only, what you can say, marine mode, that is shipment mode. Now here, in case of FOB, CFR and CIF, in case of FOB, CFR and CIF, these three, delivery occurs, that is the risk is transferred when the goods are placed in board the vessel at the port of loading. So once in the board of the vessel the goods are placed in FOB, CFR and CIF, the seller's risk is transferred to the buyer. Okay, so in case of FOB, so you can just 1 minute. These three, in case of FOB, CFR and CIF, so once the goods are placed on board the vessel at the port of loading, the risk is transferred from the seller to the buyer. Next is CPT and CIP. Delivery occurs, that is the risk is transferred when the goods are handed over to the first carrier. So CPT and CIP. So once the seller is delivering the goods in the first carrier, because here as I told you it will be multi-mode of transportation. Up to some extent it may be in some mode transport road, then maybe from the ship, right? Then maybe So something like that will be there, no? So multimodal transportation. So once the first one, okay, once the first carrier, okay, up to whatever the carrier goes, first carrier, so there in CPT and CIP the delivery of the goods as well as the risk transfer happens. Then in case of FAS, okay, in case of FAS, okay, the risk transfer, the delivery and the risk transfer happens when the goods are placed alongside the vessel, because here FAS is like, you will, it is marine, as I told you, these four are marine mode: FAS, FOB, CFR and CIF. So FAS mode, what will happen once it is free alongside, right? So once the ship is there and alongside goods has been delivered, so then seller's delivery as well as the risk transfer is over. Then FCA. So in case of FCA, the delivery occurs, that is the risk is transferred when the goods are placed at the disposal of the buyer or by loading them means of transport provided by the buyer. Okay, so it is FCA is free carrier, right? So the buyer will be providing the transport and it will be loaded with that. Till the time you are loading them into the buyer's, okay, transport, FCA will be there. So these are the, Incoterms you have to remember. There is no other go. I tried to just map it by giving some idea. So once you go through it, the material, no, and once you read what is free career, what up to what, it has to be done, so you will be easily remembering. Only once you have to go. So specifically higher scales, you have to go through this Incoterms. It will be asked which one is the, where the sellers is having high risk, okay, where the seller is having low risk, okay, which Incoterm, where buyers is having high risk, where the buyer is having low risk. So like that will be also asked. So accordingly you can, answer in the exam. Accordingly you can answer in the exam. Next is a documentary credit. So next we will go for an LC. Now in case of LC, if you see 1 to 2, 2 to 3, 3 to 4 and all, so generally 2 or 3 questions are coming from this. Okay, generally 2 or 3 questions are coming from this part. Now how this LC is working, so those who are not aware, I'll tell them in a basic way. First one is importer exporter are there. Suppose importer is from India, so he wants to import something from a overseas, and means some other country, okay, some other country. Now exporter also wants to sell the goods to the importer, right? But now how the transaction will going to happen? Either importer has to make the payment first, okay, or the exporter has to send the goods first. Now they don't believe each other because they are into the different countries, okay, they are in the different countries. Now if the importer will pay the money, exporter does not make the shipment of the goods, then it will be problematic. Or if the exporter ships the goods and the importer does not pay him, then also it will be a problematic. So they don't believe each other. So then the concept of this LC mechanism comes. The concept of LC mechanism comes. So what happens through a LC? How they are going to do the transaction? So what they will do? First, importer and exporter, they will be having a contract. Okay, so these are the goods I want to purchase. This is the price. Okay, and this is the payment term. Right. So once the contract is over, now what the exporter will say? Now exporter is not believing to the importer, so what exporter will say to the importer that you go and get a LC. Okay? You go to your bank and get a LC. So that's why if you see, the importer will come to the bank. Okay, the importer will come to the bank. So importer is the buyer, exporter is the seller. Okay, so importer will go to the importer's bank and open the LC. Now once this bank opens the LC, okay, once this bank opens the LC will be sent to a advising bank. Okay, the LC will be sent to a advising bank which will advise to the exporter. Okay, which will be advising the LC, okay, letter of credit, to the exporter. Now question comes in the exam. So the genuineness of the LC will be verified by the advising bank. Okay, so the genuineness of LC will be verified by the advising bank. Okay, so now once the advising bank advises the LC to the exporter, then the exporter what will do? It will export the goods. Okay, it will export the goods and you will get the documents, bill of lading. Then there will be another bank for the negotiation, further negotiation. It may be the advising bank or maybe any other bank. Okay, it may be the same advising bank or any other bank who can do the negotiation, further negotiation through the documents. So let us take another bank. Okay, so another bank is there who is going to do the negotiation, further negotiation. So advising bank, he advised the LC, duty is over unless until he is any negotiating bank. Okay, now the negotiating bank will come into the picture. Now what is the negotiating bank's role here? So the negotiating bank will get the documents from the exporter and will make the payment. Okay, will make the payment, and the payment he will collect from the bank and will hand over the documents. So that will be the negotiating bank's role, that is collecting the documents from the exporter, that is bill of lading and all, and handing over the documents to the bank which opened the LC and making the payment to the exporter, and this negotiating bank can collect the payment from the LC opening bank. Right, now this negotiating bank, okay, sometimes the exporter will say, I don't know this negotiating bank which you have chosen in my country. Okay, I don't know this bank which you have chosen in my country, so please provide me another bank. So at that time IOB means our bank may think of another bank, okay, who will confirm that LC. Yes, if the bank doesn't pay, I will pay. So confirming bank putting the guarantee, giving the guarantee. Confirming bank will give the guarantee. Please remember, question comes from this area. So who is verifying the genuineness of LC? It is advising bank. Who is negotiating the documents? It's a negotiating bank. And who is giving guarantee to the LC? It is the confirming bank. Right? So confirming bank and negotiating bank can be the same. Okay, confirming bank and negotiating bank also can be the same. Okay, only difference is confirming bank means bank is putting the guarantee. Okay, bank is putting its guarantee. Right, now once the negotiating bank has made the payment to the exporter and document is submitted to the bank, now bank will make the payment. Okay, now bank will make the payment to the negotiating bank or the confirming bank. Okay, and bank will hand over the documents to the importer. Okay, bank will hand over the documents to the importer and will get the paisa back, money back. Okay, now the importer will go with the document and will show the documents at the port and will get his goods delivered to him. Okay, will get his goods delivery to him. Okay, now there is another bank that is called reimbursing bank for the reimbursement of the LC. So reimbursing bank means, suppose the negotiating bank and confirming bank is there, so they require money, because they have to get it back. Once they send the documents, they need the money back, whatever money they have paid. So sometimes this bank, okay, our bank is maintaining nostro account with some other bank. Okay, suppose our bank is maintaining nostro account with some other bank. Okay, so that bank will make the payment. So that bank is called as a reimbursement bank. Okay, that bank is called as a reimbursing bank. Okay, reimbursing bank means nothing. It is just like the where our bank is maintaining a nostro account, so that he will repay on that. Okay, he will reimburse the amount. So that is all about your LC phenomenon. And here what is very important is advising banks role is to verify the genuineness of the LC. Second one is that is Confirming bank gives guarantee to the LC. Third one is reimbursement bank, means the bank where the bank is maintaining the nostro account. Other details let us see in the next slides. Okay, other details let us see in the next slide. Now, from LC point of view, whatever points we are going to discuss, question will come from here only. Question will come from here only. So you have to understand it. Okay, you have to understand it. What is a LC? Okay, what is a LC? What is a letter of credit? It is an unconditional undertaking. Okay, it is an unconditional undertaking given by the bank. Given by the bank on behalf of importer. Okay, on behalf of importer in favor of exporter. So these wordings you have to be very careful, because very means conceptual questions are framed. Okay, which one of the following is true? So this on behalf, in favor of, okay, on behalf and in favor of, these all are there, no? So there they make the confusion. So always the importer will come to the opening of the LC. So it is the importer's bank who opens the LC. We have seen in the previous slide also. And the LC is opened on behalf of importer in favor of exporter, because exporter is the beneficiary. Okay, exporter is the beneficiary of the LC. So importers in favor of exporter on behalf of importer. So these two words are very important. And it is an undertaking to make the payment on presentation of the document as per the terms and conditions. Here please remember, bank deals with the documents, not with the goods. Questions are framed for 2 to 3 and above. One example will be given. Okay, and there the options will be like, if you read the question you will feel that no, because there is defective goods, so the payment should be denied. So like that will be there, but you cannot deny the payment, because bank will deal with the goods documents, not with the goods. So that way they are confusing you. So you can in the real exam question you will be finding out those type of questions. And here the applicant is the buyer or the importer. Beneficiary is the exporter of the goods on whose behalf we are issuing the LC. Issuing bank is the bank who issues the LC, that is the importers or buyers bank. Questions are framed, that's why it is mentioned here. Advising bank, I already told you, it is advises the LC to the beneficiary, and it is liable for the genuineness of the LC, I already told you. Confirming bank, I told you that it adds guarantee to the LC. Negotiating bank, which negotiates the documents, it may be the confirming bank or the other bank. Okay. Next is LCs are governed by UCPDC 600. So for the lower scales, what is the full form of UCPDC is important. Uniform custom and practice for the documentary credit. Okay, uniform custom and practice for the documentary credit, and UCPDC 600, okay, is the right now going on. Now there are some articles in UCPDC 600, and article 5, okay, tells bank deals with documents, not goods. So sometimes question also comes, bank deals with documents, not goods, as per the which article? So article 5. Then article 14 is very important. The nominated bank and issuing bank shall each have a maximum of 5 banking days following the day of presentation to check the genuineness of the document. Very important exam point of view. Every year it is being asked. 21 calendar days, 5 banking days. You have to remember, don't get confused, it is banking days. Okay, it is banking days. So the nominated bank or the issuing bank, each one is having 5 banking days after the following the day of presentation. Today it is presented means from next day 5 banking days will be calculated. From next day the 5 banking days will be calculated, and this is article 14. So any defect is there, okay, in the document, okay, any defect is there in the document, whether there is genuineness is there or not. So they have 5 banking days time, they have 5 banking days time to check it. And please remember, this banking day starts on which day they have received the document. From the following day, 5 banking days. Next is, a presentation must be made by or on behalf of the beneficiary not later than 21 calendar days after the date of shipment, but not later than the expiry date of the credit. So the document presentation has to be done within 21 calendar days from the date of shipment of goods, but the very important thing is, but not later than the expiry date of the credit. Several times every year question comes, every year, that is 21 calendar days, and you have to ensure also that the expiry date of the credit is not over, not later than the expiry date of the credit. So these two things you have to remember. Very beautifully questions are framed. If you see, very beautiful questions are framed. If you see, it will be giving an example, okay, with an expiry date, okay, with an expiry date, and options will be given. So that you first blindly will put the 21 calendar days, but the answer will be not later than 21 calendar days, and also but not later than the expiry date of the credit. So they confuse with the options, okay, they confuse with the options in the exam. Then for lower scales, if there is no indication of insurance amount required in the LC, if there is no indication, okay, in the required amount of no indication of the insurance in the required amount, then the insurance coverage must be at least 110% of the CIF value. So 110% several times it is asked. So if there is no indication of insurance, the insurance coverage must be at least 110% of CIF value. Then if the word about approximately is used, if the word about or approximately is used, then the tolerance level is used is plus or minus 10%. So if in the goods anywhere it is mentioned about or approximately, then it is plus or minus 10%. Tolerance level is plus or minus 10%. Then if the credit does not state the quantity, then the tolerance level is plus or minus 5%. So if quantity is not mentioned, then plus or minus 5%. If about or approximately what is used, then the tolerance level is plus or minus 10%. Then types of LC, very important, and guaranteed, okay, irrespective of the scale from 1 to 2 and above, guaranteed 1 or 2 question will be framed from the slides. First one is irrevocable LC and revocable LC. So what do you mean by irrevocable LC and revocable LC? Revocable LC means that LC which can be cancelled or amended without prior consent of the beneficiary. So if that LC can be cancelled or amended without prior consent of the beneficiary, then that is called as a revocable LC. But if the LC cannot be cancelled or amended without the consent of the beneficiary, or it has to be amended or cancelled only with the consent of the beneficiary, then it is called as a irrevocable LC. Okay, it is called as a irrevocable LC. And if nothing is mentioned in the LC, if nothing is mentioned in the LC, then the LC is irrevocable. Okay, if nothing is mentioned in the LC, then the LC is irrevocable. Several times this question has come. If nothing is mentioned, then the LC is irrevocable. Then Next is with or without recourse LC. With recourse LC and without recourse LC. So where the beneficiary of the LC holds himself liable to the holder of the bill if it is dishonored, it is considered as a recourse LC. Okay, it is a with recourse LC. And where the beneficiary of the LC is not liable if the LC is dishonored, then it is called without recourse LC. So if the beneficiary of the LC, beneficiary generally is the exporter, isn't it? Now if the exporter is not liable, okay, is not liable, then it is without recourse. And as per the RBI, banks should not open with recourse LC. Means bank should not open the LC where the beneficiary is liable for the dishonor of the, okay, where the beneficiary is dishonor of the, beneficiary is the liable for the dishonor of the LC. So RBI is telling to the bank that you should not open with recourse LC. Then next we will be discussing about the restricted LC. Restricted LC means if the negotiation is restricted to a particular bank. Now we have seen in the flow chart, after the advising bank has advised the LC, suppose next the document, okay, negotiation has to be done by some bank A. So if it is mentioned particularly, then that is called restricted LC, because the negotiation of the document is restricted to the particular that bank. So it is called as a restricted LC. Next is the transferable LC. Okay, next is the transferable LC. So please remember, transferable LC means the LC is having a specific clause which gives the beneficiary to transfer the LC to in part or full, okay, to one or more beneficiaries, but it can be transferred only once. That is very, very important. Question framed here. Several times questions framed here. So in case of transferable LC, the beneficiary of the LC can transfer in part or in full to one person or to many person, okay, but only once. The transfer is going to happen only once. Okay, that is very, very important. Next is back to back LC. Okay, next is back to back LC. Now back to back LC is generally opened who are not actually the manufacturer. They are procuring from somewhere and selling to somebody. So what they do, by giving one LC as a security, they, on the basis of one LC, they open one more LC. So that is called as a back to back LC. Okay, that is called as a back to back LC. So by giving one LC as a security, one original LC as a security, they open one more LC. So that is called as a back to back LC. Second one is standby LC. So 100% several times it has come, and this time also it will come. Which type of LC is similar to performance guarantee? So it is called standby LC. So standby LC is similar to the, okay, performance guarantee. Standby LC is similar to the performance guarantee. Next is revolving LC. Okay, next is revolving LC. So revolving LC, the LCs are given for more than one dealing and rollover transactions takes place. Means one limit is given and the LC revolving happens. Okay, one limit is given and there are several LCs are opened and closed within that revolving limit. So that is called your revolving LC. Next is very important, red clause LC. A red clause LC means LC with pre-shipment credit facility to the beneficiary for procurement or the manufacturing of the goods to be exported is called as a red clause LC. Red clause means pre-shipment benefits are there. So that you, red means pre-shipment benefits are there. Green clause means warehouse. So when green clause comes, then you have to remember storage and warehouse facility will be given. So red and green, red clause LC means pre-shipment credit will be provided in the LC. Okay, and in case of green clause LC means post-shipment warehouse facility and storage facility will be given. Okay, so LC with pre-shipment credit facility to the beneficiary along with storage and warehouse facility is called as a green clause. So warehouse and storage name is coming greenhouse, green clause LC. Pre-shipment credit for manufacturing and procurement of the goods and all are there, then red clause LC. Next is the type of bill of lading. Okay, next is the type of bill of lading. Then type of bill of lading. First one is onboard lading, then closed bill of lading, clean bill of lading, long form lading, short form lading, and through bill lading we will discuss. Onboard lading means it acknowledges that goods have been put on the board of the vessel. That is called onboard lading. Means it is giving acknowledgement, that is it acknowledges that the goods have been put on the board. So in the bill of lading you can see that it is an acknowledgement that the goods have been put on the board. Closed bill of lading. Clause means there is a defective. Please remember, any clause is coming means defect is there. So closed bill of lading means there is a defective condition of the goods or the packaging is defective. So any closed bill of lading you are getting, you are seeing, then there will be superimposed clause or the notation that declares that the goods are defective or the packaging is defective. Clean bill of lading. Clean bill of lading means there is no superimposed clause as above. So if there is superimposed clauses are there for the defective goods or the packaging, that is called as a closed bill of lading. If there is no superimposed clause, then it is called as a clean bill of lading. Then long form lading and short form lading. Long form lading means all the terms and conditions of the carriage are given on the document. So it will be a long form because all the terms and conditions are covered there. So that is called as a long form lading. If the terms and conditions are not mentioned, then it will become a short form. Terms and conditions are not there, so it will become as a short form lading. Then the last one, through bill of lading. Through bill of lading means it will cover all the voyage covering several mode of transport. So whatever the mode of transports are there throughout the journey, all the mode of transports will be mentioned there. It is called as a through bill of lading. Okay, it is called as a through bill of lading. Next is the some important terms we very often which is coming. So 2-3 are there. One is arbitrage. Okay, one is arbitrage. So if you see, so many times it is coming. So many times it is coming. Arbitrage means it is the taking advantage of rate difference between two market. Now what happened? Now you have gone to the market for purchasing onion. You have purchased the onion at kilo 40 rupees. So 5 kilo onion you have purchased. Then on the way you are coming, you saw that 40 rupees onion per kg you have purchased. Another place you are seeing that kilo is 50 rupees. People are buying like anything. Now what you have decided? Okay, 5 kilo you have purchased. Okay, 4 kilo let me sell here. Again go back and I will purchase there. So what happened? So you took the arbitrage benefit. That means, so there is a rate difference between the two different markets. So in that market it was 40 rupees kilo, in this market it is 45 rupees kilo. So 5 rupees benefit to get, you have done a arbitrage trading. So that is called as a arbitrage. Second one is a swap. Swap means simultaneously purchase or sale of foreign currency of different maturity. Different maturity is very very important. So when simultaneous purchase or sale of foreign currency of different maturity happens, the transaction is called as a swap. It has asked in the past, so that's why you have to know this. If time permits, we will discuss some other future option and other items also, and whatever comes from in the question we will discuss in another session. Then for higher scales it is important balance of payment and balance of trade. Okay, balance of payment and balance of trade. Now what is balance of payment and what is balance of trade we should know. So balance of trade means export minus import. So whatever export of goods are there, and if you deduct the import of goods, export of goods minus import of goods, whatever the value comes, that is called your balance of trade. Next what you have to do, then you similarly you have to net of services also you have to take. Okay, that is balance of trade, it has come. Next you will be taking is the for the services, because it is for the goods alone. So next you will calculate the net position of invisibles. Net position of invisible means export of services minus import of services. Okay, export of services minus import of services. Then whatever position we are getting, that is called net position of invisibles. So then if you add both balance of trade and net position of invisibles, if you add 1 plus 2, whatever you are getting is the net current account position of the country. Net current account position of the country. And next you have to again calculate net capital account transactions of the country. So once you get that, if you make current account net balance minus net capital account, whatever you are getting is called your balance of payment. Whatever you are getting is called your balance of payment. So first you have to get the current account transactions. How will get? So net of, okay, balance of trade, that is export of goods minus import of goods, you will get the balance of trade. So that is done for the goods. Next you have to do for the services. Export of services minus import of services, you will get net position of services or invisibles. Then if you add both, then you will get the current account, net current account position of the country. Then next similarly you will calculate for the net capital account transactions, net of the capital account transactions. And if you minus from the current account transaction to the net capital account transaction, means amount, whatever you are getting, that is called is your balance of payment. So higher scales it is important, balance of payment, balance of trade and all. So we'll stop here guys, already 11:16 time is there. Okay. Then tomorrow we'll discuss about the ECB and trade credit. The time will be, which time will be convenient for you, whether it is afternoon or will be in the evening. So you can type in the chat box, so that we'll decide. Tomorrow is holiday, no? So what time? So ECB and trade credit tomorrow we'll discuss. So what time you are comfortable, you can type in the chat box. So accordingly we'll decide. Okay, accordingly whatever the maximum time frame comes, we will be considering. Okay. Yeah, here if 3 minus 4, that is current account transaction is more than the capital transaction, then we are surplus. Okay, if it is 3 minus 4 is negative, then it is called deficit. Okay. Net capital account, how to calculate? So capital account transactions are, I have already discussed, that is related to investment and all, right? Investment in equity share, properties and all. And whenever transactions are happening, so net outflow, okay, for the capital account transaction and net inflow of the capital transaction. So that minus once you do, you will get the net capital account transaction. Because current account transactions are related to export, import, business, no, it is difficult. Capital account transactions are limited. So net outflow of the capital account transaction and inflow, if you minus, then you will get that. Afternoon. Okay, so some people are telling anytime, afternoon, evening, same time, audit at a branch. Okay, 8 p.m. Okay, so good night to all of you. So tomorrow we'll discuss about the ECB and trade credit. It will be useful for the specifically for the higher scales. Okay, specifically for 2 to 3 and above. 1